Hi everyone and welcome to another video included in the Zenfinex educational series. My name is Connor and I'm the Senior Market Analyst at the company, providing to you daily videos on market analysis and educational content. For today's video, I'm going to be giving you a beginner's guide on the relative strength indicator, more commonly referred to as the RSI indicator. I'm going to run through the theory in a clear manner and then I'm going to move on to the chart and show you some examples of how best to utilise this indicator. Okay, so to start us off, I think it's important really to quickly run through what an oscillator is. And yes, the RSI indicator is one of those. Now, oscillators are chart index that can assist a trader in determining overbought or oversold conditions in ranging or should we say non-trending markets. Now, it is that overbought or oversold condition really which is the most important thing to take away from this lesson today. And why are oscillators beneficial? Well, they can give warnings to traders on key changes in trend that are coming up, and this is really what we want as investors, right? They also are considered to be leading indicators, so they are predictive in nature. However, with this predictive nature, you should be aware of fake signals, especially in leading indicators. So, moving on to the relative strength index, the more specific indicator that we're going to look at today. And just for some background, it is a very popular momentum indicator and it was developed in 1978. What it does to us is just like any oscillator really, it provides us traders with signals on how overbought or how oversold a market is. And it's often plotted beneath the graph of any asset price. However, the most important rule to take away from here is that an asset is usually considered overbought when the RSI indicator is above 70%. And it's considered oversold when the market is below 30%, and I'll show you what I mean on the chart. Okay then, so for those of you who are interested in the math behind the formula, I'm just going to quickly show you how the RSI is calculated. Now it comes out as a percentage, so the RSI is equal to 100 minus 100 over 1 plus RS. Now the trickiest part of this formula really is the RS part of the formula, which is this part here. So I've showed clearly how to calculate it. So RS is equal to the average of X days up divided by the average of X days down. That probably still doesn't mean too much to you, which is absolutely fine. It didn't mean much to me when I first looked at it either. So I've split up each part of how to calculate RS for you. Now the average of X days up is, let's say for example you were to use the most common form of RSI, which is the 14-day RSI. What it will do for you is it will determine how many days the market finished up in those 14. Then it's going to add those total points gained in those days, and there's your figure for the average of X days up. And you've probably guessed it for average of X days down. It's exactly the same method, but for the down days. So, for example, if you were to use the most common form of RSI, the 14-day RSI like we're using, it will determine how many days the market finished down in those 14. Then it's going to add the total points lost in those days. Then you have your average of X days down. So I'm on the daily chart now. This is just a plain Euro USD chart. And each candle from a daily chart represents a daily movement. So when this candle closed, that's a full day's trading. Now, I'm now going to add the RSI indicator. Here we have it. And as you can see, it pops up below, and what it does is it sets the default time frame to 14 days. If I was on the hour chart, then it would set it to 14 hours, but a lot with indicators, what you should notice is the higher the time frame, the more reliable the indicator normally is. So I think sticking with the 14-day RSI is the best way to do it. You can change it if you like, but I'm going to use the 14. So we have the average of 14 days, referring to the rule from earlier. Hi guys, thank you for listening to this video. Just really quickly wanted to touch on a really exciting offer we have on the website. It's a limited time offer, and if you head over to zenfinex.co.uk, you will see the offer in front of you straight away. And this is that you can trade forex on a standard account with raw spread plus zero commission. And now Zenfinex is also an FCA and no dealing desk execution broker. If you are interested in this offer, you can get in touch with the team by clicking learn more, or you can simply go to open an account where you can start the application process. And what I'll do is I'll just bring it up here for you. Anything above 70%, so this line here indicates overbought territory. Anything that's below 30%, which is this line down here, that indicates oversold territory. And as you can see, if you go back in time really, you can see where the market has given signals potentially that the price is going to change. Now you can see that this is back in March 2021. We were approaching oversold territory and we started to run to the upside. You can see that all the way back here, and you can mark it with your chart as well. Again, oversold territory here. Let's have a look at when we was in some overbought territory, which was around here. You could see that we started to fall down from overbought territory. But like with any indicator, they're not perfect, and like most things in life really, nothing really comes easy. Now it'd be wrong for me to sit here and say, well, you just buy when it's oversold and you sell when it's overbought, because I think we'd all be rich if that was the case. You do have to be aware really for these fake signals, and there was a couple of examples really where we had it. So we had the market in overbought territory here, yet the market still run up and made a new high before dropping, and that drop was a huge drop in the RSI, but not really a big drop in price. So you do have to be careful, and you do have to maybe use it as a confluence for your other strategies as well. Now, as I said, it can often throw out false signals here. Instead, I use a theory like this as confirmation with my other strategies, but the way I actually use it to trade the indicator is I use something called RSI divergence. Now, let me show you exactly what I mean by that. And I've marked some examples for you, and you can go back and you can test these in your own time as well. Now, I've zoomed right in on the chart here. So, I'll delete that for you. What we had here is we had a situation where the market created equal highs. Yep, so the market didn't make any move to the upside or to the downside from here to here. Now, as you can see, I'm marrying this up with my RSI indicator. When the market made equal highs, the RSI indicator fell. Now, this is what's known as bearish divergence. So this would have been a good selling signal for traders who were trading this divergence strategy. And as you can see, we had that drop in the market. I'll go back and find another example of bearish divergence. Again, here, this is back in June 2019. You can see the market actually now has run up and made a new high, which is a sign to us traders that the market is bullish. We should buy here. However, well, look what's happened with the RSI indicator at this time. So we've gone from making a new high, yet on the RSI indicator, we've stayed flat. Again, more examples of bearish divergence. Would have been a great selling opportunity, and look how much the market dropped from there. Now, you can get examples where you have bullish divergence, where it's actually acting as a buying signal. And I have an example here for you. At this time, instead of making a new high, the market actually run down and it made a new low. That was back in April 2019. Now, let's have a look at what the RSI indicator was doing at that time. As we created this low from here to here, A to B, we went from there to there. So the RSI indicator was going up when the market was going down, which is a sign of bullish divergence, a good opportunity to buy the market. And as you can see, the market did end up running up quite nicely. One more example, and I'm sure you get the gist of it now. So, I'll delete that. We have the market going from A to B, creating a new low. What's happened with the RSI indicator? So we've gone from oversold territory, and we've gone up in the market, yet the market's created a new lower low. Now, in my opinion, this is the best way to trade the RSI indicator, and as you can see, the market did run up from that level. It's likely to give you less fake signals, and like with anything, like I just said before, there is no perfect way or perfect system. This is how I like to see it, how I like to see what's going on, and I personally use it as added confluence to my other ways of trading. Now, have a go through the markets and try to spot the divergence yourself. Other than that, I really would like you to thank you for listening to this video. I hope it's given you a great guide into what the RSI indicator actually is and how you can use it in your trading. Now be sure to drop any comments in the comment section if you have any questions. We do always reply to the comments here at Zenfinex. And as always, continue to like and subscribe to our channel, and we will continue to provide this great value to you all. I'll catch you all for the next video. Take care.